Hello everyone and welcome to the continuation of my IFRS 12 tax accounting course. In this video, I will continue to talk about deferred tax, and in today's video the focus will be on the tax base of a liability. I think in the past video what I talked about was tax base of an asset, so in this video we'll just focus on tax base of liability, and it's going to be pretty quick, so maybe 10 minutes or thereabout, or maybe 15. I don't know how long it will take. um you recall, if you go through my videos, there was one dedicated to deferred tax calculation snapshots, and this is like a summary of the snapshot. So what this does is to illustrate the summary of deferred tax calculation, and so I like to bring it forth when I want to talk about any aspect of deferred tax, just to remind us of what the overall picture looks like. And so this is the overall picture of deferred tax calculation, and in this case I'm now focusing on liabilities because we're talking about tax base of a liability. So the first column talks about the kind of liabilities, I mean typical kinds of liabilities you see on the face of financial statements. And the next is the book basis. The book base is the current amount of each item on the face of the accounts. So the trial balance, so what's the value of your trade payables, what's the value of loan payables, value of interest payables. That's the book base, that's the accounting base. And the next column is tax base. So tax base is like carrying amount, but from a tax point of view, and that's what I'm going to try to explain in this video. In the previous video, I talked about tax base of an asset, or how to determine it. So today we'll be doing the tax base of a liability. And so in trying to calculate deferred tax, the starting point is to know what your current amount is, which you don't need a calculation for, you just pick it from the accounts. The next is your tax base, which you need to determine based on the definition provided in IAS 12. And so the difference between your book base and your tax base gives you a temporary difference. And once you have your temporary differences, there's certain principles you need to go through to determine whether those temporary differences are fully recognizable. If a portion is not recognizable, then you need to back out that portion, and that's what you see in the column D. So you back out the unrecognizable temporary differences from the full temporary differences, then you have recognizable temporary differences. You determine the applicable tax rate, which you multiply by the recognizable temporary differences to give you the deferred tax balance. And so that's the deferred tax balance you've got. But again, for some reasons too, a portion of your deferred tax assets aren't recognizable. If you have such, you then need to back it out. You back it out using column H from column G, and you then have the closing balance to say, yes, at the end of the year or at the end of the period, this is how much deferred tax asset or liabilities I have in my books. And to determine what goes into the P&L for the period, you need to just go back to check what the opening balance was, because you would have done this exercise, and in the closing of the previous period. And that's what you have in the opening deferred tax asset or liability column. So the difference between the closing now and the opening in the beginning of the year or in the beginning of the period gives you the deferred tax charge or income for the period. So that's a snapshot. This is the overall process, and we're taking it bit by bit. So we're still talking about tax base, and today's focus is tax base of liability. In other videos we'll talk about temporary differences, tax rates, and a few other things. And so this is the definition of tax base of a liability by IAS 12, and that's in paragraph 8. And so it says that the tax base of a liability is its carrying amount less any amount that will be deductible for tax purposes in respect of that liability in future periods. In the case of revenue which is received in advance, the tax base of the resulting liability is its carrying amount less any amount of the revenue that will not be taxable in future periods. It's pretty long, but to make it easy, you could just focus on the formulas I've provided just below the definition, which I have derived from the definition. So for a general liability, the tax base is the carrying amount minus the future tax deductible amount. So you need to look at the liability itself to say that this liability, what portion of this liability will I be able to deduct in future against taxable profits. If you determine that amount, that's your future tax deductible amount, and you take away that future tax deductible amount from the current amount to determine your tax base. It's as simple as that. But in certain cases, your liability is not a regular liability; it's a deferred revenue. And so deferred revenue is essentially advance payments received from a customer for a project that you have not delivered. So you've sold, a customer has paid for something, but you've not delivered the goods to them or you've not provided the service to them. You cannot recognize the revenue yet, but you can take the cash. So it means you are owing them that much, the worth of the cash you have received. So it's technically a liability. But for the purpose of deferred tax, we won't use the general deferred tax definition. We won't. The way to determine the tax base of a deferred revenue is to use that separate definition dedicated to deferred revenue. So you would not use the general definition of a tax base of liability. Use the definition of the tax base of a deferred revenue, even though it's still a liability. And the definition is simple. Just focus on the formula. So the tax base of a deferred revenue is its current amount less any future non-taxable amount. So you need to look at the revenue, the deferred revenue, to say what portion of this revenue will not be taxed in future. That portion is what you need to deduct from current amount to determine your tax base. Just in case it's not clear, I'm going to go through 3 separate illustrations, and hopefully by the end of those 3 illustrations, it should be very clear on how to determine the tax base of any liability that comes to mind. And so the first is this illustration. It talks about the tax base for a provision. In this case, I've used them all spillage cleanup provision. So the illustration says that an oil spillage occurred at one of Cornfield Limited's oil production sites in the Niger Delta region of Nigeria. Cornfield Limited estimated the cleanup cost to be $5 million. They have therefore booked a provision for the cleanup. However, in Nigeria, all spillage cleanup costs are tax deductible only upon payment. So in this case, they've been an oil spillage. They have then booked a provision to say, okay, we think it's going to cost $5 million to do the cleanup of the site. But of course, they've not paid for it. They've not done the cleanup. And so what they've done is to make a provision to say, yeah, we estimate this much, and you book a provision. And they're saying that in this country, which is Nigeria in this case, you cannot get a deduction for that provision until the payment has been made. So we know that as at this period, that payment has not been made. It means there's no way they would have gotten a deduction. The deduction will only happen when the payment is eventually made. And so we need to then determine the tax base based on this scenario, based on this illustration. And so you're going back to the solution on this screen now. So you see that the current amount is $5 million, which is still back from the question here. And going back to the definition of tax base of liability, it says tax base of liability is the current amount minus future deductible amount. So you see that A is current amount, which is $5 million. What's the future deductible amount? So as at the end of this period, we booked a provision of $5 million. It's still a provision. We have not taken a deduction because the law says we need to get a deduction when we have paid, and we have not paid, but we expect to pay in the future, and we expect to deduct that $5 million whenever we pay it in future. So it means as at now, what we expect our future deductible amount to be is that $5 million, and that's why you see that on the row B. And the formula is essentially A minus B, which is your current amount minus future deductible. And that's how we've concluded that the tax base is 0. It's 5 minus 5. As a tip, in most cases, the tax base of a liability is either equal, it will usually be equal to the current amount or 0. In most cases, it will either be the current amount or 0. It will be one usually. There will be rare cases where it's not exactly that way, but in most cases, it will be either the current amount or 0. Just so you should know that. So that was just illustration 1, pretty straightforward. And so let's go to illustration 2. This is about the tax base of deferred revenue. So we've said that this company is called Polytech Inc. It's a software company that has received an advance payment of $100,000 from a customer for a software license, and this money was received towards the end of 2023. And this software license will be delivered between 2024 and 2025. And the revenue will be recognized evenly over that period. So they will recognize revenue in 2024 and 2025. And so what this illustration is that we want us to determine the tax base of revenue under 2 scenarios. So in the first instance, you want to assume that the advanced payment is taxed on an accrual basis. And in the second instance, second scenario, you want to assume that the advanced payment is taxed on a cash basis. So, Accrual basis means that the point where that cash is recognized as revenue, that's when it's going to be taxed. Cash basis means that the point where the cash is received, that's when it's going to be taxed. So let's go to the solution of scenario. So we're going to look at the first situation. The first scenario is where the first scenario of this second illustration is accrual basis. So we're saying that we're going to be taxing the deferred revenue when it is recognized as revenue in the books, when that cash is recognized as revenue in the books. And we're determining the tax base for the period ended 2023. Current amount is standard, is not changing, is $100,000. Future non-taxable amount. So this is the end of 2023. I have received $100,000 as deferred revenue. If we're assuming that it's going to be taxed on accrual basis, it means, what we know is that at the end of 2023, we have not accrued for the $100,000 we have not recognized it as a revenue. I've not booked it as revenue, so it's not been taxed already. So it means in future we are going to tax the 100. We have not taxed it now. But what we're determining is future non-taxable amounts. We are not determining future taxable amount, we are determining future non-taxable amounts. So is out of that 100, is there any portion that will be non-taxable in the future? The answer is no. Because the entire 100 is going to be taxable in the future. So when you ask, is there a non-taxable amount for the future? No. So that means the non-taxable amount is 0 because there's nothing that will be non-taxable in the future. Everything will be taxable in the future. And put that 0 there. And you do your A minus B and you get your tax base. Straightforward. But under the second scenario of the second illustration, we're saying that the deferred revenue will be taxed on a cash basis. The cash was received in 2023, even though it's not been booked as revenue, but it's been received in 2023. The assumption in this case is that it's going to be taxed when it is collected, when the cash has been received. The cash was received in 2023, and it is going to be taxed in 2023. So 2023, we assume that amount is going to be taxed. So do we have a future non-taxable amount? Yes, I'll say. We don't. So I have already taxed the 100 already. So in future, there's nothing else to tax. So what amount will not be taxable in future? It's a full 100, because in future, when I then recognize that 100 as revenue in my P&L, I'm not going to tax that 100 again because I've already taxed on a cash basis. So the future non-taxable amount is the 100 revenue that will be booked into the P&L when it is realized. And so if your current amount is 0 and your future non-taxable is 0, then your tax base becomes nil because A minus B, 100 minus 100, gives you 0. And the final scenario we're going to do today, it's the tax base of accrued fines and penalties. So in this scenario, we're talking about Medco Pharma Inc. and they have accrued penalties and fines of $250,000 for regulatory fines. And this company is resident in the country where fines and penalties are not tax deductible. And so we want to solve the scenario now. Again, the current amount is still $250,000 in this case. And the illustration, the question, the way to determine tax liability is to say the tax base is your current amount minus any future tax deductible amount. So we know the current amount is $250. How much is going to be deductible in future? Nothing. Because if we go back to the scenario, the question, the second bullet point says this company is in the country where fines and penalty are not deductible. So whether it's just a provision it has been paid, it will never be deductible. So in future, nothing will be deductible, and so the future deductible amount is 0. And so your tax base is 250 minus 0 in this case, and you have a tax base of 250, and that's it. So in every case that you need to determine tax base of liability or deferred revenue, just to go back to these definitions, these two calculations. You don't have to memorize it in your head really in the beginning. Just to always go back to check. And with time, it just comes naturally. You just get it immediately. Once you know what it is, you get it immediately. And I hope this is straightforward. I hope this is clear. If you've got questions, please put it in the comment section. I will be happy to respond. Thank you and have a good day. Bye-bye.